Toronto, steady Eddie. This is the gateway of Canada, and global gateways do very, very well in emerging trend surveys, very diversified market. The financial sector isn't as vibrant or dynamic as it has been. It just isn't going to be, but very solid. Lots of immigration. The industrial market doing a little bit better. And so, hey, a good place to be. You can't go wrong in Toronto. Now, right here in Vancouver, 6.1 on the 1 to 9 scale. You see, again, a very, very kind of steady performance. You were number 1 2 years ago. Other markets have surpassed you on our rating scale. But look, you've got the barriers to entry. You're on the Pacific coast. You're the gateway to China. It's hard to build here. People want to be here. I don't have to tell you, you've got a good thing going. And you do. And it's such a beautiful city. And so this equilibrium environment, if you're invested here, you can be a buy and holder and do very well. On the housing front, yes, there's been a little bit of a dip. Asian investors aren't as primed to buy housing here. There's been a fall off among the Chinese. There's some tax issues, and the regulators kind of trying to encourage people or discourage people from ramping up housing. But this is, again, a blip in things, and you should do very well over time here. We don't think you need to be too concerned. Ottawa, the government seats are always cushioned by government, and so not a very dynamic market, but doing okay. Montreal scoring better than it has in our survey. We think it's because it's more of a value play. The other markets are kind of priced very high. It's hard to buy, and Montreal maybe has a few more opportunities, but not as good as the previous markets we're talking about. On the investment side, property types, apartments always lead our survey. They're there again. Retail very strong, office very strong, industrial doing better, and hotels even improving. They were yellow last year. On the development front, retail and office at the top. We have a lot of American retailers coming into the market, and that's kind of buoying things. Your vacancy rates are in the mid to low single digits. A great environment if you have an opportunity to build. Office doing okay, and even industrial bouncing back a little. Hotels, the only place where you really don't need much new product. So let's look at the different property sectors. Apartments are stronger than ever, always appear at the top of our survey. You're doing more apartment building here, and I think demand is going to be there. With regard to a lot of the condos, of course, there's a lot of shadow renters among the condos. And in any case, apartments, a very, very strong bet, and the best risk-adjusted returns here and in the States. Office, the story here is that downtown better than the suburbs, a clear dichotomy, and this gets back to the whole urbanization trend. But again, consider the stronger suburbs that are urbanizing into nodes are probably good plays. Just distinguish between your office parks and your kind of outlying suburban places. On the retail front, neighborhood infill, again, this goes with urbanization, very, very strong. They're kind of a buy and hold investment. You've got tight markets. They're going to constrict further as the U.S. retailers come in. Target, Nordstrom, Lowe's. I saw today that in Winnipeg, they're getting IKEA, and this is big. IKEA doesn't go into too many markets, so that's again another plus for how the West is really evolving and expanding, and we'll get to that in one of our best bets in a second. Regional malls, they're all controlled by the big institutions and the REITs, and so it's hard to buy. I'd be concerned about power centers. This gets to the whole issue of how retail is changing. They're power center retailers in the e-commerce world. They're kind of a little bit of a fish out of water. We see this especially in the States. So be careful about power centers. I'll go into that a little bit more when I get to the States. Industrial, Industrial is mostly a story about Ontario. And of course, the car industry is real key. The car industry coming back some, that's strengthening things. People are fairly well disposed to industrial, real bread and butter, and a good hold, but not very dynamic. Hotels doing better, RevPAR up, occupancies doing well, a really solid hold. We see real improvement in hotels from the last few years. They've come back with the economy. And our best bets for Canada. Well, you do this well, as I say, hold core real estate in major markets. How can you go wrong with really good properties in the best places like Vancouver? If you're going to develop green. Don't think about anything but that, because that's what tenants want. That's what they're looking for: flexible space with the various efficiencies in terms of air and light and electricity and power. Land bank in Western markets. Anything infill in your Western cities, the Albertas, the Edmontons, but the Winnipegs and the Saskatoons and this is where people are moving and where growth is heading. So that's a good bet. Anything infill is good, again, because of the urbanization trends. But then housing away from some of the urban cores, like in Toronto and maybe even here, there's going to be demand. A lot of the Generation Y crowd that is going into condos now is going to move back to housing at some point, because they're going to want to raise families, and a lot of the in-town types of projects that are being built really aren't conducive to that. So housing has a future outside of the cores, we think. And then, hey, this will probably be a good time to buy luxury condos in this dip. Nice apartments in the best areas with the best views and the best locations. They're going to fetch a premium over time, and if there's a little dip now, hey, go for it. So that's Canada. Let's contrast briefly with the United States, and then Chris will get up here and make his comments. I'll try to go through this quickly. U.S. is in recovery, but it's slow. It's like the old Heinz anticipation commercial. When is it really going to happen? It's like a truck going uphill. But all the stats point to recovery. Multifamily has been doing very well in the States. If you've been invested in multifamily, you've done exceedingly well. Even the office vacancy rates are starting to come down. You see where we are right now. This is the predicted, has a long way to go, but they're headed in the right direction. Still very high. I mean, this Canada, you would never see anything like a suburban or even a CBD office above 10%. But headed in the right direction. The same with industrials. Starting to come down after these record highs. But the reason is not because of a lot of demand, it's because there's really been no new supply coming on. And that story is the same in the retail front. Starting to come down, but that's because there hasn't been any really new supply. And I hope these numbers aren't right, because I don't see this coming down with this going up. The demand is just not there. And for the reasons I was talking about, retailers are constricting the amount of space, smaller stores getting out of the weaker malls. You're seeing a lot of dislocation in the States on the retail front. Single family is even starting to come back. Building permits going up, prices starting to rise, especially in the best markets, foreclosure rates going down. So housing is getting better, and that should be a buoy to other real estate sectors too. And so when you look at prospects by asset class, real estate looks good compared to everything else. And all these lines and bar chart, basically this says real estate is really kind of outperforming stocks and bonds. And we're seeing it in our emerging trend scores. We ask average market score for the major markets on the 1 to 9 scale. Look, we're up to 5.6 here after the 2010 report bottom. Things moving in the right direction. Same thing on our property sector scores. Things headed up. So the story is good, but it's like 3 yards in a cloud of dust, the old Ohio State offense. It's going to take a long time to score touchdowns in this market, but we're getting used to it. At least things are moving in the right direction. And what's holding things back, and why we're calling this year's report Recovery Anchored in Uncertainty, is all this uncertainty I talked about in the context of Canada with Europe and China and the fiscal cliff and the lowering standard of living. it's just not an environment that's going to create great dynamism. So our emerging trends, top trends for the states, you're going to see chasing yields. The big gateway markets like New York, Washington, San Francisco are overpriced. So now investors are looking in secondary markets. The opportunities there are kind of thin, and so they've got to be very careful. And the local players are going to do best there. A lot of people, if they're going into these markets, better team up with locals. Very thin. And what we see in the states over and over again is when investors start to chase yield in secondary markets, cap rates start to come down, and at some point they get burned because the demand just isn't there. And I think we're going to see that playing out again over the next 3 or 4 years. Just like in Canada, transaction value conversion, there's no really great conviction, and I think that's indicative of what I was just telling you. Risk increasing as you go into secondary markets. The big gateway markets overpriced. Perplexing interest rates, the biggest risk to investors in the States, because if interest rates go up, a lot of people who've been living off low interest and have been making deals off cap rates and not factoring what exit cap rates will be if interest rates go up could get burned. So you got to watch interest rates. We think multifamily, a lot of development activity there because demand has been so strong. We think in some markets, in the hot growth markets where there are no barriers to entry, there'll be issues in overbuilding in the next 2 to 3 years, but not in the big gateway markets where there's still a real demand need, like you'd have in Toronto and Vancouver and the big cities here. Housing coming back, we haven't seen green in our survey in years. The place where it's really lagging is in the leisure home market, golf course communities. Hey, if you want the Florida condo, if you want the Arizona condo, this is the time. We've said this for the last few years. You can still get really good deals there. It's the time to move. Playing it safe, the best risk-adjusted returns, really in the mezzanine debt, preferred equity space. Senior debt, interest rates are too low. Lenders have to be careful. Core is overpriced in the best cities, and commodity, you got to be careful about. Our top trends, technology is impacting job growth. We've talked about this in emerging trends for the last several years. It's also, as I said before, shrinking needs for demand in space. And so space is less important, less space per capita, driven by technology, lower standard of living, real issues in the States. And I think it's going to come here too. We talked about unprecedented changes in tenant demand. We've been seeing that in the States. It's an issue here. Other demand changes we've talked about in the past. Office parks are going out of style. Retail is shrinking space. Shippers eliminating distribution links. On the capital flow side, a significant amount of capital available. Again, the issue is there's just not enough good product, and that's where you get this chasing of yield. Cap rates, very nice spreads to treasuries, but then again, that gets back to interest rates and what happens there. There's good availability of debt capital. We're not worried about all this refinancing activity that we are concerned about, hundreds of billions of dollars. Troubled loans are getting taken care of or extended and pretended. And so things are hanging in there. Well, let's look at our markets to watch. This was last year's survey. And again, the red, the green, and the yellow. Green around the coast for the most part. But if you look at this year, a better picture. And I'll go back. You see last year and this year less red. Detroit and Cleveland and Providence, Sacramento still red, New Orleans not rated high, but again along the coast pretty strong, and more yellow and less red. So markets again improving. And this is, I think, the most important thing to look at here. Last year our number one market was Washington. It has now fallen on the investment side to number 12. Still a very solid 6.43 rating, down from 6.93. But I think that's indicative of what you're going to see from our gateway markets. The San Franciscos, New Yorks, Bostons, still very strong. But again, they're overpriced. And so you're going to see a fall off in investment vigor there because they're just too pricey given demand. Demand, again, tempered across all markets because of some of those trends I was talking about before. Property types in perspective, apartments on top. I've never seen such a high score in emerging trends before. This is the highest ever for development in apartments. and the demand is there, and there's no demand for new space anywhere else, so developers are really going in there, and there's maybe another 2-year window for most developers on the apartment front there. And apartments, best risk-adjusted return, if you're investing in the States and you want to know a property sector, well, it's apartments. And so match up apartments to the best gateway markets, and you're golden. Industrial is improving. This is a big buy signal for industrial, especially in your top, again, gateway markets. Hotels are making a comeback. Strong buy signal here for limited service. The Courtyard by Marriott, the Embassy Suites. This is sort of the no-frills business traveler favorite, and they're doing very, very well. And from an operational perspective, you don't need the food and beverage overheads. And so these hotels are doing quite well. But the big full-service hotels in major markets are too, and the New York's off the chart, Washington, and in some of the resort areas also. So a real comeback there. Again, on the office front, CBD beats suburban. The office park out in the hustings, this is not where Generation Y workers want to be, and this is not where companies want to be. They want to be in the cities. Retail, again, watch power centers. Power center stores, you're going to see more of them move into the best malls. You're going to see more consolidation. You're going to see more e-commerce strategies with some of these centers, and so they're not going to need as much space. And a lot of these stores are going to be disintermediated. They have started to be. It's a continuing trend. So watch power centers. Neighborhood shopping centers and infill areas, very good. And the same, if you have a Fortress A mall, you're golden. If you have a lesser B or C mall, watch out. So our best bets in the States, concentrate acquisitions on budding infill locations. Again, green office. Develop select industrial, and again, your best markets. And anything with an R in it, repurposing, refinancing, renovating. We don't need a lot of new space in the States. What we need is space being reconfigured and considered for these new age trends. So that's emerging trends, 2013. Pretty good story. Much better than we've seen in the States. Continuing improvement. Canada looking pretty solid. So not a bad year ahead, as long as the Middle East doesn't blow up, Europe manages to get through, and China doesn't have a crisis. But all that said, we should feel pretty good, right? So I want to invite Chris back up. Thank you very much.